Imagine receiving a cherished inheritance, perhaps a family home or a portfolio of investments that has grown significantly over the years. It is a wonderful gift, but a common question often arises about its financial implications. Specifically, many wonder about the tax burden on these assets, particularly concerning capital gains. Yes, for most inherited assets that have appreciated in value, the stepped-up basis is indeed automatic. This means the value of the asset is adjusted, or stepped up, to its fair market value on the date of the original owner's death. Now let us explore why this happens. The core mechanism here is tied to what is called the cost basis. Your cost basis is essentially the original value of an asset for tax purposes, usually what the original owner paid for it. When an asset is inherited, the tax rules allow its cost basis to be reset to the fair market value as of the decedent's passing. This unique provision helps prevent what could otherwise be a significant tax burden for beneficiaries, as they would be taxed on gains accumulated over many years, potentially decades, that they themselves did not realize. This adjustment primarily applies to assets included in the deceased person's taxable estate, like real estate, stocks, and mutual funds. It generally does not apply to assets such as traditional individual retirement accounts or other tax-deferred retirement plans, which have their own specific tax rules for beneficiaries. So, what does this mean for you as a beneficiary? When you eventually sell an inherited asset, your capital gains tax will only be calculated based on the appreciation after the original owner's death, not on the appreciation that occurred during their lifetime. To benefit fully, it is crucial to establish the asset's fair market value on the date of death. For publicly traded stocks, this is straightforward. It is the closing price on that day. For real estate or other unique assets, you will need a professional appraisal. Maintaining meticulous records of these valuations is essential, as these documents will support your tax filings. Understanding the concept of fair market value is paramount. This is the price an asset would sell for on the open market, assuming a willing buyer and a willing seller, with neither being under any compulsion to buy or sell, and both having reasonable knowledge of relevant facts. In some cases, an executor might elect an alternative valuation date, which is usually 6 months after the date of death. This option is typically considered when asset values have declined after the death, and its use is governed by specific Internal Revenue Service rules. Ultimately, the automatic stepped-up basis is a significant advantage for heirs, potentially saving thousands or even hundreds of thousands of dollars in capital gains taxes. By resetting the cost basis to the date of death, you, as the beneficiary, can sell inherited assets with a much smaller, or sometimes zero, taxable gain. This understanding empowers you to manage inherited wealth more effectively and confidently, ensuring you are prepared for the financial responsibilities and opportunities that come with it.